on the fixed income side, I mean, last week we saw First Bank's Eurobond surge to an all-time high of $100.75, a development we had RenCap attributing to the improvement in the perception of international risk. What's your take on investor sentiment right now, whether it be local or foreign, about Nigeria? Because we have just outlined the broad overall picture when it comes to Nigeria's economy.
Well, from where we sit, we haven't seen such a significant change in investor sentiment. I think part of the reason we saw the surge on the Eurobonds had to do with more of local factors than international factors. As we speak, there's a glut of liquidity in the market, in the local markets, both on the foreign currency and on the Naira. And we've seen a lot of players looking for alternative assets to invest those funds in. In the past, the Eurobonds had not been a predominant option for the local investors and the local banks. But what we've seen is that with this excess liquidity, these bonds have become an alternative investment for them, which is why we saw quite significant demand for these bonds.
Well, in this context, then, run us through some of the development we're seeing on the currency side of things.
Well, as we speak, the Naira is trading at about 150.50 in the interbank market, and the CBN official rate is around 150, 149.80, 150. Last week, we did see significant demand, and we saw the central bank increase their supply to meet this demand. As at yesterday, or by the end of last week, the demand had subsided somewhat, and with that, the central bank reduced the supply they offered yesterday, but we've seen another resurgence in demand. I wouldn't be too worried at this point, considering that there's still significant inflows coming in from the oil sector. Last week, we saw close to $150 million coming from the oil sector, and this week we expect to see more. And I think for the time being, we would stay at a resistance level of about 150.80 and support of about 150.
Well, in a broader context as well, I mean, we've seen banks starting to reduce their deposit rates anywhere between 10 and 15%. I mean, if this continues, surely when it comes to the interest rate side of things, we're going to start to see customers also request reductions when it comes to their loan rates as well. Are we seeing any evidence of that starting to unfold?
Yes, that is actually what is happening right now. What we have now is, as we speak, there's about 350 to 300 billion in excess liquidity in the market. And this is as a result of the inflows that came in first from when the government was trying to bail out the distressed banks. We still have an overhang of that liquidity, most of which is in the fixed income market right now. And then the excess crude funds that has come into the market has also exaggerated the situation with more liquidity. Now, what we've seen is that lots of banks have reduced their deposit rates to as low as 5% and even less than 1% for fresh funds. And this again is just to address the fact that they're getting in more than they can deploy. Remember that a lot of banks are still a bit wary about lending to customers, considering what happened last year and the loan books of many banks that had to be written off. But again, on the other hand, we've seen customers, the good customers, coming to the bank saying, look, if you're reducing deposit rates and I'm earning from about 500 basis points on my deposit rates, I'd expect a reciprocal reduction on my asset side. So I expect that if this liquidity overhang continues, we would see customers asking for their loan book, the price on their loan book to be reduced to probably the 12% levels.
Sola, have we actually seen any move on the interest rate side, on the lending side of banks? Has that actually changed yet or not?
Sorry, I didn't get that question.
Have we seen bank lending rates decline yet at all?
Well, yes, on a case-by-case basis, what you'd find, and I'm sure you wouldn't be surprised, is that banks haven't come out publicly to say, look, we're reducing lending rates. But what you'd find is that considering the banks are caught between a rock and a hard place in the sense that they have excess liquidity and they're worried that the few assets they have on their books might migrate to other banks who are ready to offer this customer lower rates. So what they're doing is that you'd see banks approach those customers on a case-by-case basis to review those rates if there's a threat of those assets migrating to another bank. So yes, we've seen some banks reduce pricing on their lending side.